I am here today with Cindy Diccianni of Diccianni Financial Group, and we're talking about the basics of investing. And in part 2 of this series, we're going to get down to some of the real basics. And so with that, I just have to call out the elephant in the room and say that over the last few years, with the way the economy's been, some of the banking debacles, there's a lot of people I know who are questioning, why should I not just keep all my money under my mattress?
Ah, yes, the infamous mattress. I think every client that comes in wants to talk to me about that. The issues obviously with that are so multifaceted, but let's touch on a couple really key points. First point is you lose the ability to fight inflation if you keep your money in something that feels really good or really safe. Put your money in your mattress, obviously you've got a different set of issues regarding that, but if you put your money in the bank, although it's safe and it's highly liquid, which is always good for part of your money, you lose the ability to combat anything with inflation. And you know as well as I do that the price of gas today, as well as groceries and everything else that we buy and consume, has gone up dramatically over the last 30 or 40 years. Certainly the prices of durable goods in general go up quite a bit. So if you put your money somewhere where you're going to get 1% and the basic inflationary rate runs anywhere between 3 and 4% every year overall as an average, then you know you're going to be behind the 8 ball pretty quickly. Not a great idea if you want to have money for retirement, not a great idea if you want to be able to buy things down the road. So that's primarily the reason for investing. There are ways to invest to hedge losses and mitigate losses, and we're going to get into some of those topics as we go on with our investment basics series.
Yeah, and so really if I want to be able to buy a gallon of milk later, I can't just put everything where I think it's quote unquote safe, because ultimately I'm essentially, from what you're saying, losing money each year over the long term, but I want to have some of that money there for when I need it.
Absolutely, and you know the other problem is that it's not a perceived loss. It's not like watching your brokerage statement go up and down or your investment statements go up and down. It's a loss that you really can't perceive until you go to use that money down the road to buy something, and that's really where you feel the loss.
Yeah, and so with that, it sounds like there's some real risks both to what we've seen from action and investing, you know, that up and down thing that you referred to, and also some real risks to inaction. So can you talk a little bit about the risks of both and how they're different and how
Sure.
you help me avoid those?
Action risks can be if you're in investing and you're too aggressive or not aggressive enough. There's a fine line there. Part of what we do when we meet with our clients is determine exactly where their comfort levels are. We do something called a risk assessment. And by doing a risk assessment, we know then exactly where the client should be and how much they need to keep in cash so that they have some money solvent, how much money we can actually invest, and where their comfort level lies. Because when the market's going up, everybody can handle risk. But boy, I'll tell you, when we hit those bear markets and the markets start going down, everybody goes running for the hills. So we really want to be very cognizant and aware of the fact that everybody does have a risk level that they can't live beyond, and that's a very, very important aspect of active investment. In terms of inactivity or not putting your money in the market, that the level of risk that you take is pretty severe, except the one big thing is you don't see or feel it immediately. It's a long-term effect. So by being inactive and saying, no, I'm going to wait till I'm 40, or no, I'm going to wait till I'm 50, or I'm going to wait till I'm retired, those years you lose moving forward, and that's called an opportunity cost. You lose the ability to make money now for the future use later, and that is a very, very important aspect of investing that you really need to do. If you do timed investments over and over again over the course of time, you will fare very, very well.
Yeah, so it sounds to me like what might feel good to me and safe now will lead to an uh-oh moment later on.
It's absolutely true. That uh-oh moment will come when you don't have the ability, which is called human capital, to work anymore and make more money. And that is not the time when you want to think and sit back and realize that you should have done something when you were younger.
Yeah, and so a lot of part of what keeps me in, questioning whether to act or even in inaction is the fact that a lot of this terminology scares me. So maybe you could just talk a little bit about what's going to be coming up in the next couple chapters of this series.
What's going to be coming up are we're going to look at each individual subtopic of investing, whether we talk about equities, which would be stocks, or bonds, which are fixed investments, or annuities, or long-term care, life insurance, whatever the topic happens to be. We're going to cover each one in the same concise method that we're doing right now. We're going to give you as many different pieces to the pie, and we're going to have it on our website so that you can click and replay it at any point in time to get some more clarity and a better understanding. The other piece that we have is on our website. There are related articles on the investment series that we are discussing now that you can also download. You can print them if you'd like so that you have hard copy, or you can review them on the website. Our website is www.dfgpa.com. On that site as well, there is a terminology list under the articles category, so please feel free to take a look at that. That will also help explain many of the terminology, different elements of terminology that we're going to cover.
Well, that's great. So I can combine different methods of learning all together with this video series so that I can really start to feel more comfortable with this in a plain English sort of way.
Absolutely.
Super. I look forward to the next episode.
Excellent.